A very great evening to all of you, and a very happy new year because in the year 2025, this is the first episode of Friday Fleet. I, CA Kalpana Thakur, welcome you all in our 34th episode of Friday Fleet, an initiative of women empowerment. Now, ongoing is our current series of areas of practice, specifically non-traditional area of practice that we are having. And today we are having a very important topic. Before I would mention anything about it, let me introduce our today's speaker. She is Shefaali Doshi. She is a Mumbai-based CA and has a diversified experience in equity research, goal-based financial planning, and she was heading accounts department of one of the esteemed organization. Her journey of becoming CA was is very inspirational, and it was part of a book named Swing, published in the year 2020. She has also been awarded Star Woman Award by Institute of Chartered Accountants of India recently in March 2024. And today it gives me immense pleasure to introduce her as a speaker on our platform because Shifali is someone who is consistent and dedicated in her journey towards excellence. And coming to today's topic, a step in the arena of international taxation. Most of us must have heard it most of the time that this is the area, lucrative area where we get remunerated very well. And we have the right person to speak on the topic. And I will not take much time because we have already waited for 5 minutes. With that, I would like to hand over the stage to Shefali. So, Shefali, over to you. Thank you so much. Let's have a virtual applause before giving the virtual podium to Shefali. So, over to you, Shefali. You are on mute.
Yeah, so good evening, everyone. And thank you, Kalpana, for such a wonderful introduction. And it is your humble nature to say all these kind words of appreciation. And I hope I am up to the mark to those words. So today's session is really very close to my heart. The topic is very, very in current topic and my personal favorite. So without wasting much of our time. And before that, I request you all to bear with my sore throat because of some unusual weather and other reasons. So please bear with that sore throat. So the session, I would like to make it very interactive rather than I just browsing through the PPT and going through the slides. I would like everyone to participate. So it will be a very informal session on a very formal topic. So I would like all of you, I would like your thoughts on the area of international taxation. So what do you understand? Anyone, if they have come across the practical aspects of work in their practice, because I know many of you are in the practice. So I would like inputs from your end, please, before I begin with the presentation. Yes, please. I'm waiting for your answers. Whatever you understand. At least you can say why international taxation is the area which is gaining so much of importance in today's time. No answers? Is it that difficult? Or am I asking something wrong? I'm not asking for your kidneys, girls.
So now it is very, as compared to a few years back, now business cross the border is increasing. The FDI limits are enhancing. That's the reason the foreigners are coming in India, Indians are going out um, outside
Yes,
India. So, and that's the reason it is in much
correct.
demand and discussion.
Correct, correct. So, the two basic reasons which I have covered in my slide, apart from the other reasons, the value of global trade in goods during 2022 increased to $25 trillion, which was just $19 trillion before the lockdown. This is the numbers which are shared by WTO. Ideally, 2023 numbers should be taken, but in the absence of any reliable data, I have considered the data for 2022.
Shifali, can you please keep this in slide show mode?
Okay, okay, okay. Yeah, is it
Yes,
better? Yeah,
yes, yes.
okay. So, yes, it's the movement, global movement of goods and services has been over $30 trillion during 2022. $25 trillion for goods and the rest $6 trillion towards services. And this volume is expected to grow at the rate of around 3% annually amongst all the developing and developed economies. Regarding, one second, yeah. So regarding the rest of the part about the relevance and the basic principles why international taxation or how it works. So, as Kalpana rightly said, there is increased movement of capital and people across the globe. Also, we need the countries who can self-assert about their taxing rights and responsibilities as well as liabilities. Next is if there is a double taxation or multiple taxation, it will not encourage the investors to do cross-border transactions or investments, which are considered to be tax havens. The next thing is what does international transaction provides us with? So if we are on the thought process that it will help us to find out about uh, how much taxes are to be levied, no, we are wrong. It provides us with much more scope and areas which are to be dealt in the course of international transactions. So it does not only look into the levy of taxes between two or more countries, but it also helps in allocation of taxing rights between two countries, which is country of residence and country of source. Now, what is country of residence and country of source? So whenever a transaction happens between two countries, either it is between two non-residents or between two corporate entities or between a non-resident and a corporate entity. So for individuals, it is like wherever they are residing, it is the country of residence. And for uh, corporate entities, it is the place where their poem is located. So by poem, I hope we all are aware it is place of effective management. So this is the country of residence, and country of source is the place where the income is accrued to the entities. So this area of international taxation, or DTAA, it is helping us to allocate the taxing rights between these two entities, which is a country of residence and a country of source. Further, it also contributes in elimination of double taxation as well as double non-taxation and tax evasion. Now, I want you all to come up with your understanding on these terms of double taxation, double non-taxation, and tax evasion before I go ahead with explaining those terms. I would really appreciate everyone's participation. Whatever you can understand, please share your thoughts. What do you understand by double taxation, double non-taxation, and tax evasion? So can I have your views on tax evasion, tax planning, and tax efficiency? I'm surprised no one is ready to answer. So we have very limited time. So I would rather go ahead with it. So whenever a same income and same person are taxed in two different jurisdictions, it amounts to double taxation. And when taking the rescue of the tax laws and regulations, the transactions are planned in such a way that the taxes are paid neither in the country of residence nor in the country of source. That leads to double non-taxation. And tax evasion is something which is a very illegal and illegitimate way of totally avoiding the tax. It is neither related to minimizing your tax liability, nor it is related to planning your tax liability. It is totally uh, ignoring or uh, just avoiding the tax liability, which is otherwise required to be paid either in the country of residence or country of source. So these are the areas which international taxation helps you to control, eliminate double taxation as well as double non-taxation and tax evasion. And when there is a equally division or say legitimate division of taxes between the entities, what will happen is investors will be very satisfied and happy, and which will lead to promoting the economic growth as well as relations between the two entities. The next slide is about the definition and basis of international taxation. So international taxation basically covers cross-border transactions. It covers transactions between two or more persons or two or more jurisdictions. Now, what happens is sometimes a person is having a property or income in one tax jurisdiction, but the income flowing from that property or income is in another tax jurisdictions. So such transactions are also covered within the ambit of international taxation. Coming to the basis of international taxation. What do you understand by basis? At least if anyone can share. What do you understand by basis of international tax? I mean, forget international taxation. What do you understand when I am discussing about basis of international taxation?
May I?
Yes, please.
Hi. So, I think the basis of when we talk about taxation, the taxation is based on number one, residential status of a person. That is a key component. Number two is the receipt or no, yeah, the receipt of a particular income,
Yes,
and number three is the accrual of a particular income.
correct, correct.
So these three are fundamental basis on based on which a tax can be implemented or
Correct.
not
Correct.
implemented.
It can be domestic as well as international. But yes, these
Right.
are the bases. So, as you mentioned rightly, Nidhi, international taxation, it is based on various factors. So, one is the residential status of a person. The second is the source of income. Like source means it could be royalty, it could be fees for technical FTS, like fees for technical services. It could be salary, it could be business profits. So these are the various sources of income, and for which there is a separate treaty for each and every source of income. And the next part is basis for apportionment. So how it is apportionment. So when it is to be levied on a person, it will be based on the residential status of that person. If the income is related to property, then it will be based on the situs of the property. Situs, by situs, you mean the place where the property is located. And in other cases, it will be based on the source of the income. What is the source of the income? So these are the uh, basis of taxing and also the basis of apportionment. So this particular slide is all about DTAA. So DTAA is a very major area related to international taxation. The entire episode of international taxation can be covered in this particular area of DTAA. So what is the concept and what are the types of DTA we'll be learning in this slide. So basically what happens is, as I mentioned earlier, whenever a person is taxed, like same person is taxed on same income in different jurisdictions. So there are two types of different taxes which are levied based on different rules. One is source rule and the other is residence rule. So this is something which is covered in double taxation avoidance agreement. Like if say any of you, like whatever professional services you are making, so obviously we are not even happy with, like, when taxes are charged on our income at one level. So what will happen if, like, taxes are levied at multiple levels or two levels? Okay, nobody will, like, encouraging this such type of situation. So these are the main reasons or areas of DTAs. The other area is when different income is charged, but the persons who are subject to tax or the jurisdictions which are charging the tax are of same type. We will be looking into the next slides with the examples which will help you understand the concept very, very clearly. So here it is the subject matter or the jurisdiction or the person which are taxed uh, uh, more than one time. Okay. Coming to the types of taxation. So it is, one is jurisdictional double taxation, then other is economic double taxation. So in case of jurisdictional double taxation, it is same person is charged to same income in different jurisdictions. Say for example, a Indian resident who is a citizen of USA will be charged for his income in India on the base of his residential status, and he will be charged to tax in USA based on his status of citizenship. So there are two jurisdictions, same person. So this is something which is known as juridical double taxation. The next type of double taxation is economic double taxation. So here, jurisdictions will be different, but different persons will be charged to tax on same income. So to understand this, we have considered two examples. You can see there is one Indian company and there is a US based company. Okay. Now, what has happened is Indian company has paid royalty to US company. By making the payment, Indian company will deduct TDS on the royalty paid to US company. Why Indian company will deduct tax? Because it is the source country. The royalty was earned in India. So that is the source country, and that is why tax is attracted and Indian company is required to deduct tax on that royalty. Now the same income will be taxed in USA because it is residence of that country. So what is happening is same income is charged to tax in different jurisdictions. US company, same person is getting taxed in USA and India, which are different jurisdictions. So this is an example of juridical double taxation. In this slide, we will understand with example about the economic double taxation. So what is happening is there is two company, ICO, which is an Indian-based company, and there is I Inc., which is a USA-based company. Now ICO has paid commission of rupees 100 to I Inc. Okay. Now this 100 is having two parts. One is arm's length price, which is considered to be 80 as per the transfer pricing provisions. And the balance part, which is rupees 20, because it is more than the arm's length price, it is charged to tax in India, whereas the entire 100 rupees will be taxable in USA. So the 20 rupees, which is in excess of the arm's length price, is subject to tax in India as well as USA. So here the income is not same. Income is different because in India, only 20 rupees are charged to tax, whereas in USA, entire 100 is charged to tax. So this is an example of economic double taxation. Now, what is arm's length price? We will be discussing in the next few slides. But till now, we have understood what do you understand by the term juridical double taxation as well as economic double taxation. I hope we are clear till now and we all are on same page. At least reply yes or no. Girls, please reply yes or no. Am I making sense, whatever we are discussing?
Yes, we are receiving response in chat box.
Acha, okay, it is in chat box. Okay, fine. Now, in terms of the transactions which are covered under the international taxation regime. So it is basically all the transactions which attracts tax at domestic rates or in their local countries are covered in the uh, concept of international taxation as well. So it is on the sale of goods, provision of services, transfer of tangible and intangible properties, finance facility, which is related to loan between the related parties, cost sharing arrangements, and all the expenses which are related to advertising, marketing, or promotion between the associated enterprise. These are the transactions which are subject matter of tax in relation to international taxations. One second. Actually, yeah, now I'm comfortable. Yes. Lost my heart. Yeah. Okay, fine. Now, from here onwards, we'll be discussing very important terms or the terms which are very used very on and often whenever we deal with international taxations. So here, this slide, we will be discussing about OECD and UN. So OECD is basically Organization of Economic Cooperation and Development, and United Nations is United UN stands for United Nations. Now there is a lot of differences in the way these two organizations operate and contribute to formulations of treaties. OECD basically it is pertaining to all the developed nations.
Ma'am, are you sharing the screen?
Yeah, it is not visible.
Ma'am, it was, but now we are not able to see.
Okay. Thank you for letting me know. I'll just try one more time. Is it visible now?
Yes, ma'am.
Okay. Yeah, so yeah. Okay. So what happens with OECD and United Nations, the way they operate is OECD basically it is a entity which is uh, majorly formed and basically it is more active between developed nations who have a similar kind of tax systems and similar objectives. On the other hand, United Nations is a entity which comprises more of a developing nations. United Nations forms treaty which are based on the principle of source, means where the income is generated. However, OECD follows the residence principle for charging tax. India basically is not a member of OECD. It is just an observer for OECD. Whereas, as far as UN is concerned, whatever treaties India is having, they are all based on UN model. And it follows the principle of taxing income where it arises. Okay, so this is something OECD and UN model. And for each treaty, there are around 31 treaties. For each treaty, there will be OECD model also and UN model also. By and large, most of the treaties are similar with few minor differences. Definitely, there are differences, but very few are there in terms of differences. The major difference which you can see here is there is one area related to service PE taxation. So OECD model is not covering that particular area. What is service PE? We will be understanding in the next few slides. Also, India is not an active member of OECD. It is just having a observer status. By observer status, what I would like to share is it can comment on all the treaties which OECD is formulating, and wherever it has objections, it can comment on those treaties, but it will not be considered for, like, for any corrections at OECD level. The next thing which we'll be trying to understand is what is treaty or convention. So basically, uh, whenever, like, a transaction is happening between two international entities, like, say between India and USA. So there has to be some guiding principles which can govern those transactions, like how in domestic context we have an agreement whenever there is a sale or purchase happening between two domestic entity or person. So similarly, whenever transactions are happening between two countries, so these transactions are governed by this treaty or convention between two international jurisdictions. They are in a written form, which are concluded and signed between the competent authorities and based on the powers delegated by the government of those respective countries. So it is a written document which will govern all the related transactions between those two entities. So there can be n number of treaties which can happen, say any treaty between India and Japan or between USA and Japan. And all these treaties will have different terms uh, based on the understanding between those two nations at the time of signing those treaties. So as we discussed earlier, what are the relevance for DTAA or international taxation? So these treaties will act as an instrument to reduce or eliminate the areas of double taxation or double non-taxation by allocating the taxing rights between the treaty partners. Treaty partners means whenever a treaty is entered between USA and India, so India and USA are the treaty partners. It helps in distributing the rights between those two states, and it provides a minimum rate as well as the highest rate of taxes which can be levied on different kinds of transactions. There are two types of treaties. One is bilateral treaty as well as multilateral treaty. So bilateral treaty when it is entered between two countries, India and USA. And multilateral treaty is something when a treaty is entered between USA, India, Singapore, and Netherlands, or maybe USA, India, Singapore, and Australia. Whenever there are more than two countries, it is referred to as multilateral treaty, and two countries entering into treaty is a bilateral treaty. Now, permanent establishment. So whenever a government of any country, say for suppose example, a government of India wants to bring a transaction into the net of into the scope of say taxation, bring it into the net of uh, tax to be charged in India. So how will it arrive at the conclusion whether the income is taxable in India or not? So for that reason, it it considers this permanent establishment as a very important deciding factor whether that income related to that entity will be taxable in India or not. So whenever a non-resident is doing any business in any country, in our case, say entity or a resident of USA is carrying out business in India. So obviously there will be a certain location or a place of business through which it will be conducting its business. There has to be some uh, a ground or a location which it utilizes to conduct its business. So that fixed place of business where the income is earned and through which that enterprise, US entity, is carrying on its business either wholly or partly is something which is termed as permanent establishment. So it is a address which is used by US entity for carrying out its business. Okay. There are certain examples which I have given, like what all can be covered in the term permanent establishment. So a branch can be covered within the ambit of definition, a PE, then a factory or a workshop, or uh, a well, which is like, consisting of oil or gas. It is also considered as a PE. And in terms of like, natural resources, any quarry or any place of extraction is also considered as a PE. Now, there are various types of PE based on the kind of area of services which they are rendering. So one is fixed place PE. The second is service PE. The third is agency PE. There is installation PE, which is related to construction industry. The service PE is related to all the professionals like us. The fixed place PE basically is used for a person who is engaged in uh, goods, and the subsidiary PE. The agency PE is related to the principal and agent relationship. So this is all about the permanent establishment and the types of permanent establishment. Next thing we'll be discussing is about business connection. So more or less, at the instance, we may find that business connection and permanent establishment are one and the same thing, but business connection is a term which is far more broader than permanent establishment. Why? Because as we discussed, for a permanent establishment, there has to be a fixed place of business. Whereas in case of business connection, no fixed place is required. A connection can be a virtual connection also, and no place like, no fixed place is basically required. Now, say for example, how can business connection be established? So say there is one non-resident who is in USA and I am his agent over agent in India. Okay. Now I am storing certain goods or merchandise in India on behalf of that non-resident. And as per his instructions, I am delivering those goods or merchandise to that person in USA. So this is something called as business connection because I am acting totally on behalf or on the instructions or as providing services to that non-resident in USA. So this is where a business connection is established. This I can do virtually also. Say if I am not storing those goods, but I am buying those goods on the direction of non-resident as per the instructions, and immediately I am exporting those goods to USA or any other place as per his directions. So this is where a business connection gets established. Okay. So what are the essentials for establishing a business connection is there has to be a close connection or relation between two activities. One activity which is carried outside India and the other which is carried out in India. Okay, if those two activities are having connection, then there is a business connection established for that particular transactions. Second thing is just having a connection or relation is not suffice to bring it within the ambit of taxation. There has to be some income which is arising out of this connection or relation by that non-resident in respect of his business. then it makes sense to tax that income in India. And the last thing is, this connection or relationship has to be a continuous one or a consistent one. Say, suppose there are isolated or a one-time transfer of goods or services or merchandise done from India to that non-resident. Such isolated or stray transactions will not be covered within the definition of business connection. There has to be a continuous activity to bring it within the ambit of term business connection. Now, what has happened is the digitalization of economy, like the Amazon and various other portals related to uh, uh, buying and selling of goods and services or merchandise. The concept of business connection, which is earlier was restricted to certain conditions which we discussed, had to be revised in view of the increased digitalization. So now the concept of significant economic presence was also added to the term business connection. So it covers all those transactions wherein the goods or services or property which are carried out by NR with any person in India, and it also includes all the transactions related to download of data or software in India, and it exceeds a threshold of INR 20 million, or the number of users which are soliciting these business activities are 3 lakhs users. So if this two criteria is satisfied, then it will be considered as significant economic presence and it will be covered within the term of business connection and hence liable to tax in India. The last slide here is not last slide, there is one more slide related to treaty shopping. Now, what happens is, like whenever a treaty is signed between two jurisdictions, say India and USA, okay? So there are all the uh, points related to the transactions covered, or what will be the tax rates covered for any transaction between these two states are mentioned in this in these treaties. Okay, normally what happens is the tax rates which are mentioned in these treaties are lower than the domestic tax rates. Okay, however, in order to avail the benefits of the tax treaty or the lower tax rates, the residents of the the persons have to be resident of either of the contracting state or both the contracting state. An entity or a person who is resident of, say, either India or USA or both the contracting states can only take the benefit of the treaty which is entered between India and USA. However, what happens is there are entities or people who want to evade tax or, like, say, take benefit of tax treaties which is not say legitimate. So what happens is, in that case, say person who is resident, say, of India, and he is deriving any income from, say, USA, but the benefits which a treaty between India and Singapore is providing in respect of his income are more beneficial than India-USA treaty. Okay, so now what that person will do, it will organize the transaction or it will design the transaction in such a way that it gets the benefit of India-Singapore treaty. So this is what is known as treaty shopping, wherein a resident will take the benefit who is not a part of treaty entered between the two states, but he is a resident of third country, or maybe he is a resident of either of the treaty country, like say India and USA, but he finds that the provisions of India-Singapore Treaty are more beneficial, and hence he would arrange the transaction and take the benefit of India-Singapore Treaty. So this is something which is known as treaty shopping. Okay. Now there are various means which are designed to avoid such treaty shopping. Quickly, I will like to go through few next slides, and then we have to cover many areas. So transfer pricing and arm's length price. So here, transfer pricing is something that defines a price or fixing a price between business entities of a multinational enterprise. Okay. For transfer of goods and services between the intercompany. Like the M&E will be arriving a price for transfer of goods and services amongst themselves. So this is something known as transfer pricing. And what is arm's length price? The price which ideally should be decided for a transaction between two entities who are unrelated or uncontrolled. In earlier case, what happened? For transfer pricing, it was a price which was for transfer of goods or services for entities within a group. So what happens is there are all the chances that the prices will be determined in a way that an entity which is in a higher tax zone will pay a lower tax, and where an entity which is located in an area where that entity is either having no transactions or the tax rates are lower, so that the tax liability of the overall M&E group is reduced. So to avoid such kind of practices, a concept of arm's length price was derived at, which helps in arriving a price for transfer of goods and services between a group or a M&E, which would have been charged had it been a transaction between two entities who are neither related or nor controlled by each other. So this is something arm's length price, which is an independent price. And that is the price ideally which should be decided or determined for any transaction happening between group entities of a M&E. Okay. So this was something about transfer pricing and arm's length price. Now there are various methods to arrive at the arm's length price. So one is traditional method and other is transactional profits method. There are three methods for traditional methods: comparable uncontrolled price method, second is resale price method, and third is cost plus method. Whereas transactional profits method, one is the profit split method, the second is transactional net margin method, and the last is other methods. Now, as we discussed that there is lots of adjustments which are done between a M&E for the transactions of goods and services between themselves, which helps in reducing the overall tax liability of the group. So to avoid all that things, a concept of base erosion and profit shifting was published by OECD and G20 countries, which was aiming at locating the gaps and the mismatches in tax rules, and to avoid the erosion of profits for tax purpose, and to stop the run to the bottom line. Okay. So now there are two types, base. This is known as BEPS 1 and BEPS 2. There were two types, levels of base erosion and profit shifting. BEPS 1, which is a 15 action plan, and there are various measures which are suggested based on the principle of coherence, substance, transparency. And the other one is BEPS 2, which is having again pillar 1 and pillar 2. So pillar 2 basically aims at imposing a global minimum tax rate of 15% across all the jurisdictions for all the countries and for all the M&Es with a consolidated group revenue of more than 750 million euros. Okay. And currently, many countries have adopted Pillar 2. India will be declaring whether it is going ahead with Pillar 2 very soon. So we'll be getting updates from Sitaraman very soon. Now, as far as the scope of work is concerned, I hope you all are having basic understanding of transfer pricing and arm's length price. So these are the areas which provides a scope of work for professionals like us. So this is something TP benchmarking and policy setting is one area of work. The second is global TP compliances. So this is includes about the reporting requirements between the treaty countries or treaty partners, and it has to be done on an annual basis. And there are huge penalties which are levied on the partners in case of non-compliances. So it is all related to disclosure form or local file, master file, CBCR, country by country report is CBCR. And again, there is a group level compliances. Okay. The next is a tax controversy management. So this is all about adjudications and appeals, which is also having a huge scope. The TP structuring and advisory services, TP technology, dispute resolutions, and BEPS, international taxation, are few another areas which includes work related to thin capitalization evaluation, or say profit attribution and PE evaluation. It includes the risk assessment of CBCR, impact analysis of BAPS, or it may be related to POEM risk assessment and recommendations. Various areas related to TP technology includes monitoring of TP policy, establishing arm's length price, monitoring due dates and track progresses, designing and executing legal framework, analyzing intercompany transaction values. So these are the various scope of work in relation to international transaction or DTAA for professionals like us. And this was all about touching the concept and the work opportunities in the area of international taxation. And thank you so much for being a patient audience. And now I can take any question answers from the audience.
Participants, either you can post your queries in the chat box, or you can unmute yourself and ask if you have any question.
Everyone is having all the knowledge related to international taxation, it seems. I was a learner on a lighter note.
So there is a question from Arna. What about the tax in case of capital gain on US stock exchange?
Yeah, Harna, good question. But for this, there are various parameters which have to be analyzed. We have to go through like as I mentioned, there are 31 treaties which we will be which we are required to study before we qualify as a DIIT professional. So there is a separate treaty related to capital gains, and there are various circumstances and various areas which we need to discuss before we can decide or comment about the tax liability what you have mentioned. So it is again a entire another lecture, say of one hour or so to discuss your point. But being a resident person, yes, sorry, I've remained to read the second part. So see, for a resident person, its global income is taxable in India, right? So in that case, yes, he would be liable to tax in India for the capital gains he has made on US stock exchange. Any other questions related to examinations or how the courses are conducted? I would be happy to share that. Besides any technical question as well. Yes, it is the course is online. The course is online and you can enroll for the course on e-learning portal of ICAI. They keep on announcing the batches. It is a 42-day session for say 3 hours on a daily basis. Saturday, Sundays are off. So it almost runs into more than 2 months. And then exams are you need to check, keep a tab on ICAI e-learning portal. Arna, you need to keep a tab on that portal. And exams are conducted along with the CA final examinations, say in November and May. The passing criteria is same, 40 in each paper. There are two papers. One is transfer pricing and another is international taxation practices. Each paper you need to have minimum 40 and say aggregate 50% is required to clear. There are 31 treaties which you will be learning whenever you enroll for the course.
So I'm having one question, Shefali, if you permit to ask.
Sure, sure.
So can you share your last slide, which was there for scope of work?
Yeah, sure.
So I'm having the question from the perspective that if someone has registered for the certification course by ICAI, which you are mentioning, so those coverage of close to 30 treaties. So what are the works that person? So say for example, I have done that certification. So what I will be able to cover by doing that certification course. So can you share your slide? So last two slides, which were talking about what are the areas we can pursue in
Scope of
international
work.
tax. Yeah, scope of work.
Yeah. So as far as my knowledge goes, see, clearing the exams will help you to use that DIIT degree. Okay, but since it is a post-qualification course, it is not that certification can be done once you clear this course. As a CA, there I have seen many people who are doing transfer pricing audits, even if they have not completed this course or not cleared this assessment. Because you are a CA, right? And CA, as a CA, you can certify the documents. So it does not really, as far as my understanding goes, I could be very wrong. Please, this should not be taken on record. But clearing the exams or
No, I'm not asking from the perspective of certification because most of the work, in fact, all of them we have discussed, we as a chartered accountant, practitioners, we will be able to do it.
Yes.
My question from the perspective of understanding, even though, see, if any work we will be pursuing, there need to be upgradation, upskilling of what we know. Right. So from that perspective, my question is, so that say for example, what are the works I will be comfortable in doing after that certification? Because one thing is I myself will take that effort and make myself ready for that work by doing the self study, going through the like today's session or the practical books and the resource available online. That is one thing. And another is taking this push from any certification course. So two things happen. One is you take that, invest some money, and then take that elevation of your skill, and another is your own effort.
So it is win-win position both the ways. First of all, say I'll take up the case where somebody has not taken up this certification and wants to practice in this any of the areas which we have shared. So being a CA, there is no restriction for all of us to keep on learning or exploring new areas. And again, it will depend upon individuals' interest area or I won't comment say on capabilities, but interest areas or the opportunities one might get. Because say I may get opportunities in one specific area and you may get opportunities in another specific area. So it all depends upon the opportunities which one can get. And obviously, the certification is no barrier, for working in the related areas. But yes, it will give you definitely an added advantage. It will, keep you a level apart from others who have not undergone this course or taken up the assessment. So there is slight difference is obviously there, but it doesn't restrict you anyway for not doing any work. Only thing is it will give you a added value and it is very important. Basically, it gives you a whole new perspective into this area of international taxation. So I think I have answered your question. And obviously, globally, DIIT is something which will be recognized by international firms as well. And there are higher certifications than DIIT, which are conducted by Vienna Institute, and that is related to something added, that is Advanced Diploma in International Taxation. So which allows you to practice on an international level. Even DIIT, something is which allows you to practice and with more recognition at international level. So this is something which one should consider before taking up any practical work.
Okay. Okay.
Ma'am, one.
Yeah.
Like suppose we have done the certification.
Yeah.
Now we want first experience on this also, exposure. How we'll get the exposure?
So that is, you need to explore your connects and contacts. Keep on reading. See, nowadays, this COVID has given us a most powerful weapon of social media. Keep on writing related articles or put on sharing the related content or latest posts or developments on any of the social media platform. Make reels and put it on Instagram. Keep on sharing related content, and some right person will spot you, and that is how you can go ahead in the related area.
Yeah. Thank you, ma'am.
Yeah, I hope I have addressed your query.
Yes. Thank you.
Have you cleared the assessment?
No, not yet.
Okay. Okay.
So one final call for any remaining query, if it is, after the wonderful deliberation by our wonderful speaker for the day, CA Shefaali. Okay, so I think we are good to conclude our today's 34th episode of Friday Fleet. I would like to thank our speaker, CA Shefaali Doshi, once again for taking the session so nicely and an elaborative way. When any discussion started, it seems that 1 hour time is 60 minutes is short of, and surely we will consider if it is needed to have one more session on the same topic. And last but not the least, I would like to thank all the participants for being here to and joining the session to upskill and elevate your knowledge and practice journey. Thank you so much. Till the time we meet next, keep updating yourself. Stay happy. Stay positive. Thank you so much.
Thank you all. Bye.
Bye.